Everyone is looking for hacks and secrets to make their life easier and better. And I've got 3 ultimate things needed for successful investing: the proper mindset, the proper emotion, and the proper process. These things are all 3 absolutely necessary to be successful in investing. If you're randomly buying companies based on what people say is going to be the next big thing, you will probably not do well. It lacks mindset, it lacks the emotional fortitude, and it lacks a process. So what do I mean by these 3 things? Well, first off, guys, I'm never going to give you the one thing in the world that's going to make you a perfect investor. Why? Because anytime you want to do that, you're missing all 3 of these things. You can have the right process. You could understand the Warren Buffett method of buying. But guess what? There's a reason why Warren Buffett tells you his method. Because he'll tell you this: if you don't have the mindset and psychology, it does not matter. If you cannot handle the emotional ups and downs of markets, it does not matter. Warren Buffett has said, if you can't buy a stock and watch it go down 50% and be okay with it, you should not own stocks. I currently have 2 stocks that I'm down 50% on, and guess how I sleep? Just like this. Because I know I'm buying a cash flowing business that I think will make more money as time goes on. So it's just a matter of the market determining the right price for that company. But the emotional side is the hard part, because when you see your account go down, it can cause a lot of problems. When you see everybody out there screaming that the world is falling apart, it will cause you problems. Just go look at how the S&P earnings have fallen during recessions. We haven't had a meaningful recession in 12 or 13 years. Yeah, I know we had COVID, but COVID was such an anomaly caused by the government. They sat there and said, we're shutting the economy down. That's literally what they did, and it was so temporary. One quarter we dropped 30%, the next quarter we were right back up. I look at this, and we're at all-time highs again on GDP. We didn't experience anything. We haven't had a recession since 2008, 2009. We haven't barely had a bear market excluding COVID. This year is the first time. The emotional and mindset of this entire thing is so important. Process first. So process is very important, don't get me wrong. But it's probably the least important out of all 3. The process of being an investor is about being a value investor. It's the idea that I want to determine a value of an investment and buy it for a discount because I don't know the future and there's a lot of unknowns out there. And the less I pay for an investment, the more likely that I'm going to do well because those unknowns are factored in there. So how do you get that margin of safety? Well, you must be able to have the mindset and emotional aspect of investing, where when the market is telling you the stock or the investment is down in price, you're able to say, that's just the market being emotional. I'm going to do the opposite. Now, I'm going to give you a little secret on what I do, and this is absolutely a fact. I recently sold a stock that I realized I was wrong on, Sleep Number. And the reason I realized I was wrong on it, do I think Sleep Number will be higher 10 years from now than today? I do believe that. But I believe it's going to experience a lot more pain in the short run because of what somebody told me. Somebody said, Paul, look at their performance in the past during recessions. It's a very, very exclusive item. It will get hurt badly. In the last recession of 08-09, I think it went from $25 a share down to 30 cents a share. And as recent as last year, it was $120 a share. And I look at that saying, damn, I didn't think about that. Which I was surprised that the investor who told me this even said that. But I sat there and said, I'm going to sell Sleep Number and wait for a better time to buy. Spoiler alert, I already took a 40% hit on my Sleep Number stocks. I was fine with that, going, you know what? I'm going to save. And I got super lucky. So I sold it 2 weeks ago, and last week it fell 10% in one day or 20% in one day. But I think that it is a very, very exclusive item that will take a bad hit because people don't need to change their mattresses during recessions. Okay? And it's not like it's being sold only to elite people. You look at a company like Louis Vuitton and Ferrari. There's so much demand for those that during recessions, they tend to not take hits. Why? Because really, really rich people don't get affected. They still want to buy really, really, really nice things. But with mattresses, even a rich person would say, I don't really want to buy a mattress right now. I'm fine with my mattress. And that was something that I missed. But these are the things we look at from a long-term perspective. I purposely try to avoid selling stock even when it's down, just to force myself to be okay holding on. Do I reassess? Absolutely. But unless there's been a major change to my thesis, like that happened with Sleep Number, a major change, I'm going to stick with the investment because I believe in having the fortitude of not jumping in and out of investments. Is that the right way? It's the right way for me. It could be the wrong way. A friend of mine recently told me that he knows a guy who, whenever his stock is down 15%, he immediately sells it and waits 1 month to buy again. Why? because he wants to take away all the emotional aspect of his allegiance to that stock and say, let me reevaluate. And I think that's a brilliant idea. I don't do it, but I think it's a brilliant way to invest. You need to find the right process that works for you emotionally and for your mindset. That's what will make you the most successful investor. But you have to find what works for you. What works for me is focusing on larger companies that are selling for a discounted value. How do I do that discount on larger companies? Where is the market right now? So when I look at a company, the large companies that I want to own, I'm going to look at the overall stock market in general. This is an Excel sheet I put together. And for those of you in our community who've subscribed to our software, you will be getting this as part of the community aspect for you, updated every single week, because it's important to me to look at the stock market to GDP ratio. Warren Buffett calls it at any given time, the most accurate measure of where we stand in valuations. I created my own based on the S&P 500 and the S&P 500 equivalents going back to 1929. We are currently at 63% overvalue at a ratio of 1.5 to 1. The average historically, scroll here to the right, the average historically is 0.929, and we're at 1.5. The highest ever was 2.5 back in 1929. The lowest ever was 0.33 back in 1982. How correlated is this? The higher the ratio, the lower returns, to a metric of negative 0.81. That's a very, very high correlation. Now, does correlation mean causation? Not necessarily. However, in this situation, think about it logically. The more you pay for an investment, the less your return. The less you pay for investment, the more your return. That's all this is saying. That's all that's saying. So we look at this and say, if we're 63% overvalued, what does that mean for the future? Well, this does not include dividends, but the average 10-year return is 6.6% without dividends. If you're undervalued in history, the average is 9.3. When you're overvalued, it drops to 2.3%, 7% lower. But even scarier, when you're 30% overvalued or higher, and we're at 63% overvalued, the average return is a negative 0.1%, not including dividends over the next 10 years. That to me says that the really big companies that I want are not cheap enough. So that's why only 7% of my money is invested in stocks. But remember, if you're new to this channel, that doesn't mean you should be in all cash. I have 8 or 9 businesses upstairs. I have hundreds of units of apartments. I sell options every single day. I have multiple streams of cash flow, or my lifestyle has not changed based on how much money is in my brokerage account invested in stocks. My goal is to be 80 to 100% invested in stocks at some point in the next year or two. But I want to invest in the big companies, the Apples, the Metas, the Googles, the Microsoft, those big ones at cheaper prices. It'll be harder for me to get my 15% returns, and I'm okay with that. Because for me, it's more important for me to buy big companies that can build on themselves with a high return on capital, that they can keep reinvesting, or buy back shares to give me bigger pieces of the company. That is my goal. That's what works for me. I used to be a dollar cost averager into ETFs, which worked very, very well until I learned how to buy my own stocks. And you're probably here in the same situation. It's intriguing to buy your own stocks, but you don't know enough. That's awesome. That's the best position to be in at this time in the market. This is where you want to be. Dollar cost average into stocks, even though we're at very high levels, not all-time highs, but very high levels of overvaluation. Because if you have a long-term outlook, you need to be able to do one thing. When the market is growing like this overall, but the price goes like this, you're never going to be able to guess when the peak and the bottom will happen. So if you invest over and over, you'll overinvest sometimes, underinvest sometimes. But boom, overall, you'll make on average. Now, there is one way. I made a video about this and how you can make a ton of money using this. Just increase your investment in dollar cost averaging when the market is selling for below its historical average. And if you join our community, you will get access to this. And I will disclose it every single week in the community. I get a lot of questions in our community from people in the last few weeks who said, Paul, we love that Excel sheet. Can we see it? Absolutely. It'll be in there. And that's the point here. Our community has thousands of people in here talking every single day about investing. I have conversations with them. They ask great questions. I ask great questions of them. We don't agree on everything. That's the point. It's a challenge on questioning what you already believe. We've all made mistakes investing. I'm going to have them. Warren Buffett's going to have them. The point is, are we making our process better and better? And the emotional mentality of it, is easier in this chat. Why? Because you have like-minded people all talking. They don't blindly follow the herd. They sit there and question. When they see things flying high for no apparent reason, they avoid them. We laugh at them. Why? They could very well work out, but the one that will work out will not make up for all the losses you have along the way. And there are so many other tools in this software. We have retirement calculator, but it goes even further. This retirement calculator asks you a very important question. What age do you expect to live to? Why? Because retiring isn't about just getting to retirement. It's about living the rest of your life not worrying about money. Every retirement calculator I have seen stops at retirement, but you need to make sure you can live a longer life than you expect, because that's how you have margin of safety. That's what you do there. Other things like the watch list. I have 97 companies on my watch list. I use our 8-pillar process and my process for finding stocks, and I value 97 companies and just wait. Wait for them to hit the price I want to either buy them at, sell options at, or do more research. I don't have time to sit here and do it every single day. I just want to sit there and do it one time and then notify me when it hits the price. And when it hits that price, I reevaluate, see if my thesis is still the same. Because your thesis will change by little amounts every so often, and that's okay. What you don't want happening is that you buy a company like Workhorse, relying on it to get a government contract, it doesn't happen, and the stock falls 95%. That's what you don't want happening. And a lot of people had that happen to them. And I can go through numerous companies where that happened to people on. This market needs to wipe out a lot of people. I don't want you wiped out. I want you to get better at investing, just like I did after 2002, and I got hurt badly. I lost a lot of money buying the hype stocks. Absolutely. One of the companies I bought was Adobe, which now I regret selling, but it got wiped. Let's look at Adobe. This is a company that I owned back in 2000. Let's see what it peaked at in 2000. Let's go to the max chart. It peaked at $42 and went as low as $8 a share. Boy, I wish I'd kept that. 40 times higher. After falling already from a peak this year, all-time high of $700 a share. But if I had the right process, I might have been able to say, no, it's a good company at $8 a share. I don't know if it was. I have to go back and look. But I didn't buy it for the reasons of fundamentals. So therefore, when it fell, I had no other choice but to sell it because I wasn't able to find somebody dumber than me to go buy it. But if I was smart enough to realize that it was a cash flowing business with a lot of potential in the future, I would have kept it. And guess what? Adobe is one of my companies on my watch list, the very first one right here. And I have it on my watch list at 205. Again, that doesn't mean I'm buying it at 205. It means I'm doing more research on it at 205. Do I want to buy some shares? Do I want to sell puts on it at 150, 160? That's the process here. But guys, another thing, you can use analyst estimates on company. You can do 8-pillar search yourself. We're going to allow people to do their own editing of the 8-pillar portfolio. So instead of looking at our 8 pillars, they'll be able to make their own 8 pillars and compare them side by side, because these are the attributes that I like. But your attributes might be totally different, and I'm okay with that. As long as you have a process that works and logically makes sense about buying an asset for less than its intrinsic value. If you believe in that, you will do very well, and the software will be an extra tool for you. Again, most importantly, is this community chat. Our chat is one of the most important things because it allows us to make announcements. It allows the thousands of people here to talk with each other. You can go in here, search for the topic, search for the specific company, and go in there and actually have a real conversation with people who are talking about it. The herd mentality is tough, but if you have like-minded people, then the herd mentality can help. Because guess what? I have value investor friends, and we don't agree on practically any investment. However, we do agree on a certain process for buying stocks. And that's what's important. We're still going to disagree on the growth rates here, growth rates there. I shouldn't say we don't agree on anything. We agree on a lot of things, but when it comes to our analysis of companies, Mo and I'll sit there and say, Mo, you value this company. Guess what? He puts in different criteria, but we end up at different levels. Just like Munger and Buffett were once asked, what do you value Berkshire at? And they both said, we'd probably value it very differently. But the point is, they'd be able to say if it's over or undervalued based on their overall values. And that's what matters. So guys, this entire software is only $1 per day. You're paying $1 a day for peace of mind and knowledge. You probably pay thousands of dollars a month for college. This is $1 a day to get more knowledge than you got in college that's going to help you retire and live a great life. So go to everythingmoney.com, Sign up today, no long-term commitment, month to month, sign up now. And if you need to use PayPal, go to patreon.com/everythingmoney. You can sign up right there. This will be the best $1 per day that you spend in your life. Thank you very much for your time. There are 3 things that you absolutely need in order to be a successful investor: the proper mindset, the proper emotion, and the proper process. Which ones are the most important?